Hey Shane, this is Charles Dobbins, just so you know, or you can call me Charlie, whichever one is more comfortable for you. All right, so this is how I operate, and I typically do the first property package together uh, on a video recording where I share my screen with you, so you can see exactly how I operate and how I would analyze this particular deal. Um, but I say my first deal. If we have to do two, three, four, it doesn't matter to me. I want to help you out every step of the way and make sure you understand exactly how this is done. So the first thing I do is I look at the offering memorandum, the broker property package, and I look at it with a very jaundiced eye. I don't trust anything anybody tells me. All right, so in this particular case, I'm looking at the first page and I look at the two pictures that they have out here. And I think to myself, okay, it's a broker's responsibility to put this property in the best light possible. So therefore, he is going to do everything he can to make the pictures look good. So these are the two best pictures he could come up with. All right, let me just fix this right here. This always pops up. Okay, so in this particular case, if you look on the left-hand side, nice, beautiful trees, very low cut landscaping, beautiful green grass. Obviously, this was taken during the summer. But let's take a look at the structure. And what do we see about the structure? The first thing we see is that it's a flat roof. Flat roof in Wisconsin. Are you kidding me? Are you kidding me? That thing could be an absolute disaster. So we want to think about that as we're going through the due diligence, as we're going through the numbers. We want to think to ourselves, holy cow, this thing could be a sieve in a rainstorm or a sieve in a typical Wisconsin winter. The next thing I look at are the windows. If you look at the windows, they have these two double panes down the bottom. I'm looking for how they heat and cool the units. I don't see any type of units like HVAC units outside, and I don't see any in-wall AC units whatsoever. So my question then becomes, how are they heating and cooling this property? And that's going to pose a very big issue as I go through the numbers. Okay, it's a two building, 30 unit property. That's a phenomenal size. I love that size, especially if, in your case, I think you said you've been dabbling in real estate, you've done a few smaller deals. This is a perfect size deal. Here I am out here teaching this how to own 1,000 apartments in 5 years. And all I tell people is in your first deal, just buy 20 units. That's all I ask. Just buy 20 units. This one is 30 units, perfect size. I love this size. We got to figure out what it's going to take to make this thing work. Okay, opportunity to own a very stable asset in the highly sought after city of New Berlin, currently 100% occupied. Let me tell you something, nothing is 100% occupied. People die, people divorce, people move. And as soon as they move and you can't fill that unit within the next day, then you're going to have an occupancy. And therefore, you're no longer 100% occupied. So whenever I see a broker say 100% occupied, I think, yeah, fine, baloney. That's not how this business works. Unless the market is so incredibly hot. And I was having a conversation with a guy yesterday who said, like, oh no, I'm able to lease up my units in 3 days. Okay, well, that's Boston. But is that the case in the city of New Berlin? Can you do that in New Berlin? If you can't, then it's never going to be 100% occupied. Very little historical turnover. Now, note the term here, turnover, which means that people who move in there stay a long time. And you can see that in the financials when it talks about the turnover costs. All right. So because he says this here in the little sales pitch, we are going to look for those numbers in the income and expense statement. Laundry hookups in the townhouse units. Okay, that means the number of townhouse units, we're not going to receive a dime. All right, we're not going to make any money. And the other thing is, if we're paying for the water, we're paying for those laundry hookups. Then he's got coin operated laundry in the apartment building, which means that on the income and expense statement, there should be an income section for the laundry. Now, what this means is we have a rule of thumb as to how much money you should be making on your laundry. It's typically $10 per unit per month is what type of laundry income you should receive. Now, if this thing is 30 units, but only 15 are in the apartment building, we should be receiving $150 of laundry income per month. All right, now we'll see that as we go through the financials. All right, lot size, I don't care. Square footage, I don't care. Year built, 66. Okay, well, that's kind of a problem. That's an old building. That means that there's going to be a lot more repairs and maintenance on this property than others. That means that that roof has had to be replaced and had to be fixed many times. When you go to do the due diligence, you are going to be going through that property, looking at every ceiling, looking in the corner of every ceiling, going into every single closet, looking at the ceiling in every single closet, and looking for water damage. That's the key. That's really what you're looking for, okay? So 66 is a problem, but here's the issue. I don't know Wisconsin. There may not have been anything built like this since 66. You guys maybe have gone through a drought. Kansas City is the same way. A property built in 66 in Fort Worth, Texas is being torn down because there are so many properties that have been built in the 80s that are taking its place. But out there in certain parts of the Midwest, they haven't had that type of growth. So you really need to understand your area and know, okay, 1966, what's my competition here? Oh, you got a property down the street. Well, when was that built? 1967. Oh, okay, so I'm still in the marketplace here. So that's what you need to understand as you go through it. Construction, brick veneer, and vinyl siding, rubber roofs, flat rubber roofs pierce. When they pierce, you have to fix them. They leak. Okay, we need to get that thing inspected before we buy it. Okay, now check this out. Gas boiler heating system for the 16 unit. That means for 16 of the 30 units, there's one source for the heating and the AC. One source. That's what we call, I mean, it's a typical, same type of thing as a chiller boiler system down in Texas. These are not good properties to own. Chiller boiler systems crash. When they crash, you've got 16 disgruntled people who are calling the code enforcement officer, who is shutting down your building, who is putting these people up because the Salvation Army, is shutting them down. Listen, it's dangerous. This is a dangerous property because of these types of things. You've got a chiropractic business. You are earning a nice income from that business. You're looking for properties that you forget you even own. I'll tell you right now, if this boiler system goes, you are done practicing chiropractic medicine. You are becoming an expert on property management overnight, and it's going to be a very expensive lesson. And let me tell you something, Shane. What I just said to you sounds like it's coming from the heart and coming from personal experience. Do you know why? Because it is coming from personal experience. I've had to deal with this before, and it's a nightmare. Okay, so right away, that is a huge strike against this property. Huge strike. So when you sit down and talk to the broker, and the broker's like, oh, hey, what do you think about this deal? Hey, it's got a boiler system. It's got 16 of the units are on a boiler system. How old's a boiler system? When was the last time it was maintained? When was the last time the pipes were changed on it? Geez, I don't know, Mr. Broker. This is a tough property. I mean, obviously the seller knows this. I can't give you the price you're looking for because I know when this thing goes, it's going to cost me $50,000. It's going to cost me $50,000 to fix this thing. And the broker's going to say, oh, no, I don't think it's going to be that much. I go, really? How many chiller boiler systems have you owned? And I'm telling you personally, it cost me $35,000. I had to come up with the money overnight. Wasn't pretty. Okay, 30 parking, no big deal. Real estate taxes. Now look at it's 2016. They're using 30,872. Yeah, okay. Well, you're going to buy it in 2017. Let's find out what that real number is. Let's contact the assessor's office and figure out what it is, and figure out what happens in your marketplace when you buy the property. Do they reval the property? Do they come in here and say, oh, guess what? We're going to use the price you bought it for as the valuation. And then all of a sudden it's not 30,000, it's 45,000. You need to know that before you start making offers on these types of properties. Okay, 14, 3 beds and townhouse style. 8 2-bed and 1 bath, 8 1 bath. Okay, 2.65 million. That's the number we're using, 2.65 million. Okay, cool. Now, next. Okay, yeah. Pretty pictures, pretty pictures, pretty pictures. I don't really care. Okay, there's that big, huge flat roof right there. Look at that flat roof. Oy vey. Oy vey. And look, I think I might have it all the way through. Yeah, he's got flat roofs all the way through. Oy. But it's surrounded by a single family home right here and a street on this side. He doesn't show us what's up here. He does not show us what's on this side, what I call the north side. So you need to drive around and find out what's on this north side. Is it my competition? Look at it, that's where my driveway goes. So the driveway probably goes out to a street. You really want to look at, and the thing about Google Maps, if you can get on Google Maps, it's free, download it, it's fantastic. Google Maps is going to let you know exactly what your neighborhood is like. And this one's pretty cool. I like all the trees. Very nice. And it's a lot of grass. Listen, this is a oh, I hate the fact that it's a flat roof. I'm looking at the property right up here. I hate the fact that it's a flat roof. Man, you could pitch the roof if that's your long-term holder. That might work. All right, next thing. Let's go. All right, I don't care about that. I don't care about that. Let's see, Park View. Okay, so what do they get? They give me a pro forma. Oh, come on, guys. Come on. Give me something more than a pro forma. I don't care about a pro forma. Pro formas are made up numbers. Pro forma is Latin for pretend. I don't even want to look at this. I don't want to look at it. Ooh. Oh, wait a minute. Debt assumption. Huh. Time out here. Whoa. Have you seen anywhere in the previous 3 pages that we've been looking at that we're assuming the existing debt? I didn't see anything. Now he's telling me that I have to assume the existing debt. Essentially what he's saying is, here is the loan amount, here is the interest rate, and it's a 30-year amortization. So those numbers that I just highlighted here are fixed costs. You cannot change those numbers. As a matter of fact, what I'm going to do right now is I'm going to write down on a scratch pad these numbers, 2.65 million, okay, a loan amount of 1,987,500. Isn't that a crazy number? And then we're going to do 4.25 for the interest, okay, and it's going to be a 30-year amortization. Okay, now I'm going to need those numbers when I go into my cash flow analyzer, and I'll show you why in a moment. All right, rent roll. Okay, yeah, I'm not going to really dig into this right now. That's not important to me right now. Broker disclosure, yeah, okay, these guys are typical residential brokers trying to sell a multifamily. All right, so he really has not, okay, so all right, here are his expenses. He's got admin at 6,000. He's got the management fee at 5%. He's got the utilities at 25,248. He's got the R&M, repairs and maintenance, at 23,391. He's got the personnel, which is another word for payroll, at 6,240. Marketing of 3,000, and insurance of 9,300. No, and the taxes of, oh, now good. They went up on the taxes. Oh, yeah, good. So they did the work for you. And the replacement reserves, isn't that interesting? The replacement reserves above the line of $9,000. Now, listen, there are plenty of videos on my membership site where I talk about the replacement reserves and what they're doing here. Now, let me explain to you what's happening. Just so you understand what replacement reserves mean, it means that the bank is telling you that they say on a, hold on a second, let me do a little bit of math here. We got $9,000 divided by 30 units. Okay, so what he's saying is $300 per unit per year. This is what this means. In order for you to get a mortgage on this property, the bank is going to require you to reserve a certain amount of money per month per unit in order to spend it on the property in the form of capital improvements. And what they typically do, the number that they use is $300 per unit per year. I'm sorry, yeah, $300 per unit per year for replacement reserves. Now that means that every time you pay a mortgage payment, you're going to pay 300 times 30 divided by 12 out of your mortgage payment, and that portion is going to go into a bank account with the bank that you can use, and you can use it strictly for capital improvements. only capital improvements. You can't use it for operational expenses. You have to use it to improve the property. That's the only reason you can get your hands back on that money. Now, depending upon the bank, they will say, okay, well, you have to spend this money first, and then we'll reimburse you out of your bank account. So you got the money there in the bank account, but you got to spend it first. So it's a reimbursement account. Different lenders will handle that arrangement differently. Some of them will work with you and say, hey, listen, I just got whacked with a pipe that burst from the building to the road. That's a capital improvement. I need $6,000 fast. Can I tap into my account right now before I even pay the plumber and grab that money? Yes, we'll work with you and make sure you do that. Only good lenders do that. Walker and Dunlop, great lender. That's how they operate. Other ones will require you to put the $6,000 up front and then wait to get it out of your replacement reserve account. Now, here's the thing. The replacement reserve can only be used for capital expenditures. Capital expenditures are not operating expenses. If it's not an operating expense, it falls below the net operating income line. And when it falls below the line, it increases the NOI, and therefore it increases the value of the property. Now look at what they're doing right here. They're putting that capital expenditure above the net operating income line. Therefore, they're reducing the NOI and they're reducing the value of the property. Why would they do that? They are helping you buy this property at a lower price. Well, the thing that you always have to understand when you're looking at these numbers is you always have to think about who is your audience. Now, in this particular case, you are the audience, but at the same time, your lender is the audience. When you're dealing with a bank always puts the reserve replacement figure above the line in order to calculate out their debt coverage ratio, because they want to make sure that even after you've put money back into the property, you still have enough money to qualify for the mortgage. So that's why, from a lender's perspective, the NOI falls above the line. Now, Shane, if you're out there buying these properties and using other people's money to help you finance these deals, you're going to put that reserve replacement below the line because it goes towards increasing the cash and cash return for the property. So it increases the NOI and it makes the property look better. So you're going to make the property look better for your cash investors. And guess what? GAAP, the generally accepted accounting principles, say that the capital expenditures should be below the line. So you're not violating any rules. You're doing everything correctly. It's the broker and the bank that do it differently. Okay, so that's why you see the reserve replacement above the line. We are going to keep it outside of that number, and we're going to use it to our advantage when we're negotiating with the seller. All right. Now, so I've got the numbers. Now, the thing is, this whole thing about the debt assumption really bothers me. That here we are on page 6, and there is absolutely no discussion of the fact that it's an assumption. All right, that's a problem. I wouldn't even contact this broker. I mean, I wouldn't even make an offer until I've had a contact with a broker and figured out, is this an assumption? Because Shane, I'm telling you right now, if it's an assumption, our LOI is going to be entirely different. Entirely different. But so therefore, we can't even make this offer until we know that information. Now, let me just say this to you: if you don't feel comfortable, you think this is kind of outside your frame of reference here, don't worry about it. I will be on the phone call with you with the broker asking these questions. I will help you through this thing every step of the way. I'll show you exactly how to do it, okay? So don't be intimidated by the fact that there's this term in here about the assumptions. Don't worry about it. Now, here's your analysis. There's the apartments. You got it right there. It's 2.65. That's their asking price. All right, so we scroll down. Okay, now right away, okay. All right, Shane, take a look at this. Let me show you this. Here is your contract price of 2.65. Down here, if you enter a cap rate of 8%, the end of year valuation based upon the NOI that you calculated means that this property at an 8 cap is worth, at the end of the first year, $38 million. I'll tell you what, I'm investing in this property tomorrow because you paid 2.6. and at the end of the first year it's worth 38. So right away, I know you did something wrong with the NOI. That's okay. We'll figure it out. We'll get it fixed up. Now, here's the problem. You put in 20%, okay? But remember, they said it was an assumption. And when you're dealing with an assumption, you don't have the ability to recalculate the mortgage amount based upon the purchase price. You have to go with the numbers that exist already. So in this particular case, you have to put in 9.85 500, okay? I did it wrong. Yeah, that's good. And then the interest rate is 4.25, and it's a 30-year AM. So that's it. You can't even change those numbers. That's the number, because that's what they're saying. You have to assume the existing mortgage. And the only reason why I say that is because of that one word on the proposal. Other than that, there's no other place that even mentions it. Okay, so right there we've got to figure out what the problem is with the NOI to recalculate that. But this page is all set. Now let's jump over to the income section. All right, let me talk to you about the income. Oh boy. Okay, so let me explain to you what happens here. There are three types of units. There are only 30. There are three types of units. There are 30 units total. Up here, you select up to 10, okay? And then it pops it right up here. The reason why you do this is, believe it or not, this is one of the misnomers or misapplications of Doug's software. It says the number of units. What it should say is the number of types of units, okay? Here you've got three types of units. 30. So you're not going to use 30 units. You're only going to use 10. Okay, so here's the problem. I see what the problem is. You're putting in the annual rent for each one of these units and not the actual number. So what I'm going to do is I'm going to jump back over here. Oh, hold on a second. Did I already kill it? Hold on. I will. I'm going to pause this. Okay, so what I'm going to do here is I'm going to jump back over here to the okay, so this page I want. Now the problem with this page is you see all these different rent amounts, all these different numbers. So instead of doing this, what I'm going to do is I'm going to take the actual annual of 24,840 divided by 30 units. That means each unit is renting for $828 a piece, okay? So here, 828, oh, that didn't work out. That didn't work out very well. Here, let's try it again. 828, 828, 828. That's the 828, 828. Boom. All right, so that is what our annual, right here, potential rental income is on this property based upon the rent roll. All right, watch this. Watch this, Shane. If I jump back over here to the input data, remember how we said it was worth like 15 million, 37? Now it's worth 1.9 million. You're asking 2.65, and according to our calculations, it's worth 1.98. One thing I want to check on this thing is I want to check out the cap rate. Make sure that you did this correctly. They're saying 6.3 cap. All right, they're saying 6.3. Your job as an investor is to know whether that number is right. All right, so if I go back to the thing right here and I change this to 6, oh shoot, I apologize. I already forgot what the number is. 6.3. There we go. Okay. And I go here, 6.3, 6.3. Watch what happens to the valuation as soon as I hit enter. Now it's worth 2.42. We're looking at 2.6. Okay. Now the broker's telling us it's worth 6.3 cap rate. You're gonna need to go in and validate all that information. All right. So income. We fixed the income. We now need to go back and fix the occupancy. So let's see what he has over here. According to this, and see, here's the problem. He's telling you the total income with a 3% vacancy is 294,000. Well, hold on a second here. When we go back over here to this number, 294, All right, that's the gross potential. Now they're saying 3% vacancy. I like your 5. We're going to leave the 5 there. Okay, everything looks good. We got the laundry income of 4,900. Hold on a second here. That's not right. Let's go back here. Other income. Other income, $6,000. Okay. Now, if we take the $6,000 divided by 12, that's 500 bucks a month. Let's go back over here to this number, laundry or other. Well, let's call it right here, other income. And it's $600 a month, not 4,900. That's going to have a huge difference. Watch this. If I jump back over to the input data tab, now where it was with 2.65, now it's worth 1.685. So this property is not as pretty as we thought it was. Now let's take a look at the expenses. Oh boy, look at you go. All right, let's see here. Let's take the administration. Let me just do a jump back over here. Administration 6,000. Okay. All right. You got it all over the place. Holy cow. You got the expense ratio of 63,000. You got the total expenses of 184,000. Before I start to go back and change your numbers, let me go back and see how the what these guys are showing for total expense 127, and you're showing 184. Huh. Okay. You know what? I don't want to monkey around with your numbers. I want to know how you came up with that, because I'm not seeing these numbers up here. You might have more information than I do. Okay, you know what? So I am not going to change the expenses here. I'm not saying that yours are right. I'm not saying yours are wrong. I just want to go back and figure them out. I think, yeah, well, you know, it's a 30 unit. 10 might be high. You know, you might want to drop it down to 8. You could probably get it for 8. All right, but let's have a conversation here about how you're coming up with that number, or how you're coming up with 178,000 when they're at 127. Not saying you're wrong, nothing like that. Okay, so what we need to do is, now that we've got the yeah, look at this. These numbers are not looking good. These numbers are awfully red, awfully red. So I want to show you how this works. But before we start getting into this, we need to work on those expenses. I think you and I might need to have a conversation about those expenses so that you and I are on the same page. Okay. Right now it's showing an NOI of 112,000 based upon your numbers. The cash flow before taxes is negative, not good. The debt coverage ratio is 0.96, not happening. The cash and cash return is 0, not happening. So what that tells us is we've got to go back and we've got to monkey around with the purchase price, because we know that it's worth 1.7, but you've got the contract price at 2.7. Watch what happens when we change this to 177,951, and then we jump on over the cash flow analysis. Oh, whoop, hold on, it's got to change. Still spinning. Let's give it a second. Okay, that's that's weird. Hold on a second. Oh, you know what? I'll tell you what the problem is. Oh, here's the problem. This is the problem. We changed the contract purchase price to 177, but remember, this is an assumption. The loan amount is 1985. The loan amount is 19. If you're buying this property, you're taking on an existing loan of 1985, but the property is only worth 1.77. You can't buy this property. You just can't buy it. So, okay, Shane, before we go any further, what we need to do is we need to, because watch what happens. Watch what happens here. Let me go back and see if I can space this out. Okay, okay, cancel, retry. Okay, retry this. Okay, there we go. Okay, so if I go here, cancel. If I come up here and change it to 25%, boom. Now it changed that loan amount based upon 25%. Let's go with 20%, which is what they have now. And I jump over here to the cash flow analysis. Oh, what do you know? Now I'm up to a debt coverage ratio of 1.3. Now I have a cash and cash return of almost 8%. That's because you cannot assume the existing mortgage. The existing mortgage is too rich for this property. That's a problem. So we need to have a conversation with the broker regarding the assumption. We need to have a conversation with the broker regarding the assuming the existing debt. That's a problem. That's a deal killer. It's a deal killer. It is going to his acquisition of that mortgage X number of years ago is going to prevent you from buying this property. Hey, that's how it goes. That's his fault, not yours. Move on to the next one. But let's have a conversation with the broker so that you understand exactly what's going on here. All right. Hopefully this was helpful. Hopefully you get it. Um, and listen, let's keep working this way. All right, Shane. Have a great night. 12 inches of snow tomorrow here in New England, but we won the Super Bowl. Yeah, I'm sorry about that. Yeah, I think you guys lost to Atlanta. I think we just toyed with them. So, but that's okay. All right, pal. Good talking with you, and we will chat with you later. Thanks. Bye.